Lebas with us now from Philadelphia. He's the chief fixed income strategist at Janney Montgomery Scott. It is a firm with $53 billion under management, $12 billion of which is fixed income. He is one of the most accurate forecasters of GDP and other data. It makes him a Bloomberg best. Guy, glad you're here. Do you think the bond market is showing a change of heart? First decline in 3 weeks. It seems to us as if that's the case.
Well, the decline is relatively small in scale. I mean, you'd think in the longer run that if there's something truly catastrophic kind of on the horizon or truly a market-changing event, we'd see a much bigger move than we've seen this morning. I think what that really proves is that the U.S. bond markets and treasuries in particular have proven remarkably resilient in the face of all these risk factors, most of them coming out of Washington these days.
So it sounds like you feel like the average bond investor is getting a little bit more pessimistic, but still is hedging that the government will be able to work something out.
Yeah, I think that's a fair assessment. And there is a sort of underlying almost presumption that somehow Congress must work out a deal to raise a debt ceiling. Now, as a skeptic myself, I have a little bit less faith, perhaps, in the legislative process these days. But nonetheless, a predominant opinion is that Congress will take some sort of action. We think it's going to be an 11th hour type event where it pretty much raises the debt ceiling, perhaps coupled with some symbolic spending cuts, but really nothing meaningful in the long run.
When, Guy, do you think we're going to hear about this 11th hour deal? I mean, do you think the 11th hour is now, or is it August 1st?
We'll call it the 9.5 hour right now.
That's where we are now. All right.
Rough ballpark. So over the course of the last several weeks, the Treasury has actually taken in roughly $14 billion more in tax revenues than they had forecast, which really creates a little bit of additional breathing room. Now, don't get me wrong, there could be sort of a decline in tax revenues over the next week and a half or so that takes back that breathing room, but nonetheless, it kind of extends the 11th hour even past August 2nd, probably to the August 8th.
But, I mean, what would the market do? What do you think the bond market would do if we missed that August 2nd deadline? To me, it seems clear there's a possibility for a huge sell-off.
I think we would see a substantial sell-off. I think in terms of increases in interest rates, the biggest move would be on the very short-term obligations, which are more likely at risk of defaulting, for example, T-bills. But keep in mind that if T-bill interest rates rose about 100 basis points, 1%, a 3-month T-bill would only decline about 1/4% in value. So even if rates rise quickly on the short end, it's a little bit more manageable in terms of market value.
So you're essentially saying that even if the government, even if lawmakers miss the boat, it's still not going to hurt the bond market all that much in relative terms?
Well, I think it's not going to obliterate the bond market by any means. I mean, keep in mind we have 10-year interest rates down around 2.93% right now. So even a 1/4, 0.5% increase in interest rates, while painful for investors, really is fairly low by historical standards. In fact, I believe lower than we entered into the year 2011 to begin with.
All right, good perspective, Guy. As always, thanks so much. Guy Lebas joining us there. He's chief fixed income strategist at Janney Montgomery Scott.